Afternoon, everyone. We'll get going in just a couple minutes. Just wanted to make sure my audio is working. If there's any issues, please let me know, but we will get going right at 12 o'clock. Thank you. Good afternoon and welcome to 12 Points monthly webinar. Today we are going through your life, your wealth, your decade by decade financial roadmap. I'm happy to be here today and be your host. Before we get going, a few housekeeping items. Please feel free to share any questions you might have in the chat box. I will try to get to them by the end of this session. We'll try to hold this to 35 minutes. And if I don't get to all the questions, I'll be sure to follow up with you directly. Also, if you registered for today's webinar, you will get a copy of this webinar once the recording is complete and ready to share. And I also wanted to share our disclosures. This is important for us to share, but also there's a link there to our website. It's either 12pointswealth.com or you can access that at 12points.com. And under the Abouts tab, there's some additional webinar information, which is likely how you found this webinar. But know that all of our webinars that are coming up are placed on that website. And also you can follow, there's a link there to our YouTube channel where you can see prior webinars as well. There's a wealth of great information. Would invite you to take a look at that and encourage you to listen on the ones that are applicable to you. A little bit about me before we get going. My name is Tracy Hartford. I'm a wealth advisor here at 12 Points. I get the privilege of working with my clients to help them get a checkpoint on their life, figure out where they are today, and help them get confident about where they want to go. I love what I do, and I love being able to help people see a little bit more of what's possible for them versus what their image is when we first start working together. So with that, our agenda today, it's pretty loaded. I will go through these, but there's some just key highlights. I think that no matter what decade of life you are in, there's things that we all can do to improve our state of life and our financial situation going forward. And so today we'll go through some of these guidelines, some common pitfalls, as well as some recommendations of what to do. Maybe some, if you were to do one thing today, what would that be? I will share that with you as well. So why does a roadmap matter? We all know our financial journeys are not linear. Things are going to happen. There will be career disruptions. There's caregiving duties. There's also some earning gaps for some people. Nothing is going to go according to plan. A roadmap is simply the result of financial planning. It really helps you plan proactively and not reactively, which gets you in the driver's seat versus in the passenger seat. Some guiding principles that I think are helpful for all decades. Number one, spend less than you earn. We all know that, but more importantly, know your numbers. Understand what is coming into your household, what is going out. That is really the key to understanding how far your savings will go in retirement. We often get that question, and until we understand what your spend number is, what you have saved really doesn't tell us very much, because if you're spending $200,000 a year and you have $1 million bucket, that's going to run out very quickly if you don't have a plan on how that's going to work. And so we work with people to really understand what those numbers are. And as we start to work together, as I work with my clients, they start to hone in on those numbers a little bit more clearly. That is, I would say, the key to retirement for many, many people. Another piece that's important is starting early and being consistent. We always say that, but those that are much younger, you have time on your side. You are able to compound that interest over time, and that moves very, very quickly. the earlier you start. And it doesn't have to be a big amount. So think how whatever you can do, start as soon as possible. Yesterday was when to start. Don't wait until the perfect time. Do a little bit each time. What's also really important is building an emergency fund. Things are going to happen. You're going to lose your job. You may have someone get sick in your household. You may get sick. Planning for the unexpected is really important. And when we talk about an emergency fund, we want 3 to 6 months worth of fixed monthly expenses. What I mean by fixed is things to keep a roof over your head, to keep the lights on, to keep food on the table. The other stuff is the fun stuff, the going out, the streaming services. All of those are not considered fixed expenses. So try to hone in on what's really fixed. What can you not live without? That becomes your fixed bucket. And then multiply that by 3, maybe by 6. And if you're really nervous or if you're the only household income in your family, then maybe by 12. That is really key to make sure you have that bucket to lean on in times of when things happen. And another thing that's important for people is you should be increasing savings as your income grows. Many people will just set the limit and do the minimum on their 401k and never touch it again. Really think about increasing that. Every time your income grows, you want to put a little bit more to savings. Doing a little each time is really going to make that much easier when you get to that retirement phase of your life. The other thing is protection. I know insurance gets a bad rep out there. There's insurances that are in place for very particular reasons. Life insurance, specifically term life, we really like for our clients, especially if you have a house that you own, you have income that people depend on coming in the door. If something were to happen to you, what expenses need to be covered so that your family or your loved ones can continue living their life? We want to make sure a mortgage can be covered, maybe kids' education, and at least 5 years worth of your income that is now going to be missed. That's really what life insurance should be covering. More importantly, people don't think about disability insurance. If you were to get disabled and not have the ability to work and bring in income, many work plans do not cover 100% of your salary. Understand what that gap is and understand what money you may be missing if something should happen, because that's likely more possible of happening versus dying, at least at a young age. You really want to start to align your money with your values. Think about what's important to you. What does money mean to you? What does money serve a purpose for in your life? Once you start to think about what's most important, is it experiences? Is it travel? Is it family? Is it dining out? That's where you start to see where your money activity is. You can quickly look at your credit card statement or your bank account, see where your money goes, and very quickly you'll see what your money values or what your bank account values, and does that really align with how you thought you wanted to spend your money? The other thing is to adjust your financial plan as your life evolves. Just creating a plan when you're in your 20s doesn't mean that that's the same plan you should be using in your 30s or 40s and beyond. There's a lot to be thinking about when your life changes, and you want to make sure that you're shifting and ebbing that financial plan with your life. It should not stay stagnant. It should not sit on a shelf. The other thing is to avoid high interest debt. We all come into debt at some point in our life, either with student loans, with a mortgage. Focus on what that debt is and have a payoff plan for that, especially if you have credit card debt. If there's things that you're putting on credit card and you're not able to afford that each month and pay that off completely, then you need to work on a plan to get that off of your plate. You do not want to go into your later decades with high interest debt on your plate. Next, we're going to go into your 20s. And your 20s are really about building that awareness and building those habits. So really, again, cash flow, understanding what's coming in and what's going out. Focusing on building that emergency fund. Understand what your fixed expenses are. What are the things that you need to keep a roof over your head, to keep the lights on, to keep food on the table, the real basic needs, and build a fund that is an emergency fund and a high yield savings account. Many are still giving 3.5, 3.65% of interest. Don't keep it in your checking account. Don't keep it in your bank savings account that's giving you 0.1%. Look at those percentages and look for some other great options online. There's some great online banks that offer you some money for your money that you're saving. Focus on paying off that student loan debt. You do not want to get into your later decades having that on your plate. So have a plan in place, even if you have some payoff potential opportunities, but talk to somebody about it. Don't let that sit and ride, because interest will start to accrue. and make that even harder to pay off down the road. And really think about retirement investing. Many times this is your first job in this decade, and you have the option of contributing to a work retirement plan, a 401k, maybe a 403b. This is a great opportunity to figure out what your company or organization is matching and start with that. If they're matching 3%, which is very typical in most organizations, start with a 3% contribution and then start to build from there. I always tell people every year that you get a raise, you should be increasing that 1% because before you know it, you will be maximizing that tax benefit by contributing to your work plan. And when I say maximize, it's not 3% what your company matches. In this coming year, 2026, every employee has the opportunity to contribute $24,500 to this account if you're under age 50. If you're over age 50, you have the opportunity of contributing $32,500. You get what they call the catch-up contribution. Then there's a new rule for those that are 60 to 63, you get $35,750. So know what your options are and develop a plan around that. And again, it just takes 1% every year to grow that account very quickly. It doesn't have to be maxed out from the very start. If you're doing all these things, you're going to start to establish a really strong credit, which is really important, especially if you're preparing to buy a house. So do all of these things, focus on that debt and start saving because that's going to matter when you're establishing that credit. And then get the appropriate insurances in place. Understand what your work plan offers, but also it's probably the cheapest time to get life insurance, term life insurance in your 20s. You're the healthiest you're likely ever going to be. So take a look at what your options are. I believe I got my life insurance, my term life insurance at age 27, and I got a 30-year policy, which I'm still paying for today because it lasts 30 years, and it's great. It's very cheap. I think I pay $59 a month, sorry, for that policy. For me, that's peace of mind. I have my house. I'm thinking about a mortgage that I had at the time. I, at some point, was going to have a child. I didn't have one at the time, but I was thinking about my future self and what things I wanted to protect. So think about that when you're setting up your life insurance or different insurance policies. Basic estate planning documents. Everyone thinks thinks estate planning documents in general is just for those that have a ton of money. We all need estate planning documents. And what those are, the first things that are really key for people in their 20s or people that have just hit the adulthood of 18 is having your power of attorney and healthcare proxy. What that means is if you become disabled, you get in a car accident and you're unable to make financial or medical decisions for yourself, you want someone to be able to step into your shoes and make those decisions for you. So if you're a young 20s and your parents are heavily involved in your life, if you do not have these papers in place, they need to go to the courts to get permission to be able to help make that medical decision for you or make that rent payment. Having these basic estate planning documents is critical to make things easy when things get really, really crazy. So again, if you're in your 20s and you don't have basic documents, a will is great. I love that people get that too at this stage. It's easier to get it all done. But at a minimum, power of attorney and healthcare proxy. And again, avoiding lifestyle inflation. It's very hard as you're making more money to want to spend more money. And understanding, again, your cash flow, what's coming in and what's going out, super critical. If you're saving for your retirement, you're understanding your numbers, then yes, have that fund bucket. That is everything we should all have, is that fund bucket. When you get into your 30s, we're talking about expansion and balance. It's really understanding and balancing your values and vision. Again, know what your values are, what's important to you, and what's your long-term vision for your life. What do you want things to look like down the road, and how can you get there? Really aligning your savings with those goals. If you want to retire early, what are you doing today that's going to help you retire early? And do you know what you need to do to get there? These financial decisions really should be anchored in intention rather than reaction. We really want to be proactive. And if you're contributing to a retirement plan, increase that contribution. If you've been sitting on that 3% or that match for many years, now's the time to kick it into high gear. Because again, you've got some time for compounding. Don't wait to make that move. Yeah, emergency funds, super important. Estate planning documents, again, key documents, power of attorney, healthcare proxy. If you have children, guardianship is really critical to make sure you decide where your children go and not let the courts decide. And again, a will, if you have a house, if you have assets, if you have children, this is really important to get those documents in place. Life and disability insurance, again, understanding what you have. Know that your work coverages are not portable. So if you leave your company, you start with whatever that next company has coverage-wise. If you buy this on your own, you will always have that coverage as long as you continue to make those payments. And then again, you're investing for growth, making sure your risk is aligned with your time horizon. If you're in your 20s and 30s, you should not be investing the same as if you were in your 60s and 70s. It's very different. This is an opportunity to get some growth and be a little more aggressive than you will be later in your life. Next is 40s. This is the part I love. I work with a lot of families in their 40s and 50s. I call this the mid-career point where people really need to understand, I've done a lot. Where am I today? What's going on in my life? Where am I financially? And what do I have to do next to get to where I want to? And whether that's a career shift, whether that's retiring at a certain age, whether that's trying to afford a kid's college education, understanding that baseline, if you haven't had it at this point, this is the decade to do that. Really understand, get clarity on where you are, and really start to focus on optimizing so that you can get to where you want to be. You have mid-career, usually a lot of earning power. Things start to fall off. Hopefully student loans are paid off at this point. You're kind of in the set mode for paying off your mortgage, but you really are starting to maximize those retirement contributions and looking for other places to save. And if you're not maximized on retirement at this point, this is the decade to get there, because it really makes no sense to do anything else until you've maximized that piece. Really think about your investments and make sure that they're diversified. Putting everything in the S&P 500 is not necessarily the best thing for everyone. We want to make sure that you have a diverse portfolio so that when the market ebbs and flows, as it always will, and as it has this whole year, you want to make sure that you have enough to kind of withstand the storms that will eventually and always come. Many of those in the 40s are what we call the sandwich generation. You have aging parents that you're thinking about or maybe caring for. You also have kids that you're caring and supporting. What we want to make sure is that you're being thoughtful about the things you're doing for each of those sides without sacrificing your own long-term security. What we tell people is that you can borrow for a kid's education, you cannot borrow for your retirement. So please keep that in mind when you're making those choices. Insurance review, it's always key to make sure you have the right amount of insurance in place, whether that's life insurance, again, disability, thinking about just a homeowner's insurance. Do you have an umbrella policy that kind of helps put an umbrella over your entire asset? Think about the things that might be gaps in your plan and start to fill in some of those gaps. Estate planning, if you don't have them in place, really want to get this going in your 40s when you really can figure out what's important to you. And if you have them in place, always review them. Make sure that things are up to date. We tell our clients power of attorneys and healthcare proxies should be updated every 5 years. Institutions typically will give you a hard time in accepting them if they are not current and updated. So we always say if they look exactly the way you want them to be, go back to that attorney and just have them re-sign them and re-notarize them, and they're good to go again. Another thing about your 40s is having career optionality. Start to think about what would give you more freedom later, not just more income now. Is a career change on the horizon? Do you want to do something different? Do you want to maybe change careers, or maybe you want to stop completely working at some point? I made my own career change in my mid-40s. I had to do a lot of planning to get to that point, to understand where I wanted to be and what I wanted to do long term. So think about those options now. Don't wait until it's too late to think about what will really kind of help fulfill your life and help you enter a retirement phase of your life with a lot more joy. And again, thinking about kids, you don't want to sacrifice your retirement for the funding of your kids' education. So really keep that in mind and continue to reduce and eliminate that debt along the way. It'll make your retirement years much more friendly. Your 50s, this is really focused on strengthening, simplifying, and preparing for multiple possible futures. We want to have a good strategy. We want to have protection in place. You really want to make sure your plan, your financial plan is updated and that you're clarifying what your vision is for that, what your next chapter of life will look like, including work, your lifestyle, maybe location, And really, most importantly, is your purpose, so that your financial plan that's created supports that future you. Thinking about retirement projections, do you know when you can retire based on what you're currently spending? That's a key part. Again, I keep talking about spend, but unless you know what you spend, nobody can tell you if it'll actually last that long until they know that number. And if you've been behind, you haven't been able to save as much as you had because you had a lot of expenses with kids and family, now's the time to accelerate those savings. When you're in your 50s, you get the option to do some catch-up contributions, and there's some great opportunity there. Kick that into high gear. Again, long-term care planning, usually in your 50s and 60s, these are great times to start talking about that, because if you were to do any long-term care insurance policies, this is probably the cheapest time to do it while you're still healthy and insurable. So think about those options, so you know how you want to live later in life. Make those decisions now before someone else makes them for you down the road. Also talking about Social Security strategies. There's a lot out there on social media about Social Security strategies. Talk to a professional about what's really important to your plan and to you. Understand why someone might take it as soon as possible, why someone might wait for full retirement age, and why people might wait till age 70. There's a lot of pieces that go into Social Security strategy, including tax planning. So really talk to someone and understand what your options are versus just picking what you think you should do because everyone else is talking about that. It might not be your best solution. Again, simplify, consolidate. You don't want multiple accounts everywhere. If you have multiple 401ks everywhere, now's the time to simplify it and consolidate them either into one rollover IRA or into your current 401k or 403b plan. There's different plan rules, but understanding if that's possible, you want to help simplify and consolidate as much as possible. Another key topic that's always important is tax planning. When you're starting to approach retirement, it's understanding what happens in retirement when you're talking about Medicare surcharges, you're talking about required minimum distributions, you're talking about things that are required when you take money out of these accounts. How does that affect your taxes? And so working with a professional that can help you think that through and have a good plan in place is really important. Again, paying down your mortgage strategically. Many of us have very low interest rates on some of our mortgages that we have. You want to be strategic about when you get that paid off. You don't want to go into retirement with a mortgage on your balance sheet. So really think about how you might pay that down strategically, and hopefully it's done by the time you get to retirement. And again, updating your estate planning documents, super important. Again, your life is going to change. Make sure you're looking at those every few years to make sure that the people you have outlined in them are still appropriate. And across all decades, I didn't share this before, but beneficiaries. Make sure you check your beneficiaries, especially on your company retirement plans, your 401ks, your 403bs, your life insurance policies. All of those things bypass anything that's written in your trust or in your will documents. So if you name an ex-spouse in your retirement plan 401k, but your will says something else, whoever is listed on your 401k is who will get those funds. Review that on an annual basis and make sure you have the appropriate people listed in all of your beneficiary locations. Your 60s is about transitioning to retirement. This is the decade of moving from building wealth to using it wisely and sustainably. You want to create a thoughtful income strategy that blends all of your income sources, whether that's Social Security, pensions, maybe withdrawals from your different portfolios, but really creating a thoughtful income strategy that also blends in tax planning. You're shifting your strategy towards a balance of growth and income and stability rather than pure accumulation. And I know that sounds easy. This is the hardest part for many people, is transitioning from not getting that regular paycheck to actually taking money from the accounts that they've been saving from for decades now. And so helping you understand that process and putting together a strategy for that really starts to ease that stress about how this is going to work. You also want to implement any long-term care strategies you've chosen. So if you talked about long-term care planning or you haven't at this point, this is the time to really start to plan it while you can make these decisions for yourself. And if you're approaching 65, Medicare planning, super confusing and complicated. It shouldn't be. I feel like you get a lot of information. There's a lot of great professionals out there that can help walk you through these plans. Do not go it alone. Ask for help. get some guidance and help. There's no cost for many of these professionals, and if you need someone, I'm happy to help you. But this is really important to be able to have someone help you understand what your options are, because this is a critical time to make the right decision, because it's sometimes not something you can really fix down the road. And then again, making sure all your estate planning documents are in place, really important. Power of attorney, healthcare proxy, those should be updated every 5 years. In your 70s, this is the last decade here that I'll go through because it's 70s plus. It's really about legacy and longevity. This is the decade of stewardship, simplicity, and impact. The focus shifts from optimizing your returns to optimizing your peace of mind and alignment. We really want to focus on simplicity, clarity, and ease of management in your financial life. So really simplifying your bill paying process and the number of counts is really important here. We really want to make sure you ensure sustainability over an unsure time horizon. You don't know how long you're going to live, but we don't want you to outlive your money. So we want to make sure that there's a plan in place and that you know what sources of income are coming to you. You also want to have your own support in place to manage your health, cognitive, and fraud risk. There's a lot of risk that happens in this decade. Want to make sure that you have strong personally, medically, legally, and financially responsible people to help support you during these stages of your life. And also it's just support intergenerational communication. Many people don't want to talk with their families about what they may inherit or what wealth might be happening in the family or what could happen when they pass away. They don't talk about their estate planning documents. This is really important to do before you leave. And we're all going to leave someday. So start to have those conversations, because those conversations will help strengthen your family relationships rather than strain them when people find out after you've passed and can't ask questions. So please take consideration for that. I think that we see that as being very beneficial to many families that we work with. Now on to some common pitfalls for women, and I also have a slide for men because they are very different. We're similar in some ways, and you'll see there's some crossover. It's not to say that there's pitfalls just for women and just for men. There is some crossover, but commonly we find that women tend to be very conservative. We tend to underinvest, and we want to make sure we have more protection. We obviously like to protect everyone else financially. We put everyone else's needs first and ours second. We also tend to have more career interruptions than our male counterparts. And many times we underestimate how long we are going to live. Many women defer the financial decision-making process, and many times when their spouse has passed, it's the first time they've gotten a look into their financial future. Don't do this. Please make sure that everybody, regardless who's running it in the household, male or female, make sure that everyone understands what's going on in the family's financial kind of situation. And then also many women tend to not revisit a financial plan when something in life changes or happens, a divorce, a loss of a spouse, a child concern or health issue. These are really important to keep this plan updated, because this is really what's going to help you proactively plan and prepare. Many women wait too long to ask for help. That's one common thing we've seen. And then they delay that estate and protection planning. They don't think about the estate planning because no one likes to think about death. This is not, this I could say on both sides. It's very common, but it's super important to be able to make those decisions and not force your family to make them for you. For men, we see a lot of overconfidence in investing. So they tend to be much riskier. They want to take more risk. So being aware of that. They also tend to delay retirement savings. I'll do it later. I'm going to YOLO. You only live once. I'm going to do everything I can right now. They also tend to be more the lifestyle inflation folks. They want to keep up with the Joneses. They want to have the greatest gadgets. They also want to fund their kids' lives before their own retirement. Another key thing is making sure we say, put your mask on before you put the other kids' masks on. Super important to make sure you're protected and you have security before you start to do that for others. And many men they tie their identity to income. And I see women do this as well. So really attaching that identity and income, it becomes very hard to make a shift or change or to get out of those golden handcuffs, as we call them. They also tend to underestimate disability risk. You're likely more likely to get disabled than you are to die within your working years. So really understanding what that risk point is and what would happen if you were to get in a car accident and be out of work for 6 months. How does that impact your family's income? Men tend to avoid financial conversations too. They don't typically bring those up. And they also ignore health as a financial asset. Your health is a key financial asset because that's the most expensive thing you will have moving into retirement is your health. How does a financial advisor help? I think this is great for people who aren't working with one. First, they help create a financial plan that works and evolves around you. They help provide that clarity and that accountability that many clients want and need is that in that guidance, that objective guidance, not even just during transition, but just all phases of life. Like what should you be doing now? What is most common for someone at your point in your life that makes you different or maybe behind somebody? They also help to coordinate all of your investments, kind of tax planning, thinking about the tax impacts of certain moves. And then they also look at insurance and estate planning. What are the gaps in your foundation that could potentially pose a risk to your family and your assets? Your next steps. So if you're leaving here today, what are some things to be thinking about? Where are you on your financial plan today and roadmap? Have you got one created? Have you put something together? And what's one action that you can take this year that's going to help move your plan or your roadmap forward? If you don't have that in place, I do recommend scheduling a financial check-in or roadmap session with your advisor. And if you don't have an advisor, then maybe look for one or maybe do some more research. I'm happy to help give you some different sources for this, but there's so much out there. But make sure it's a professional. If you're taking actual advice, don't take it from social media sites. You really want to make sure someone has the expertise and has the education behind some of the recommendations they are making for you. And then if I suggest one smart move this decade, for your 20s, save, save, save. You have the power of compound interest on your side. Take advantage of it. It does not have to be a big amount. Little things will go a long way. So start to save, don't wait. If you're in your 30s and you haven't touched your retirement contributions in a bit and you're not even maximized at that $24,500 level, increase your retirement contribution today, even 1%. If you can do it, move it up. You will thank your future self will thank you. If you're in your 40s, now's the time to do a financial check-in because now's the opportunity to say, I've got 20, 30 more years to work and I can make some shifts and changes that are really going to be impactful. If you wait, it's going to be much, much harder. So do that check-in now, figure out where you are, where you want to go, and what things you need to do to get there. If you're in your 50s, maximize your retirement savings. Now's the catch-up time. Take advantage of the options of maximizing your retirement and those extra catch-up contributions and have a plan for what retirement looks like for you and when you can turn off that Monday morning alarm. If you're in your 60s, start to create a clear retirement income strategy, meaning understand where your income from your assets, your different various accounts, your IRAs, your 401ks, your retirement plans, your pension. What's the income strategy? Because there's different ways to pull in money so that your tax planning is also a part of that consideration. So really managing your tax level, your tax bracket in retirement is just as important as having the right amount of assets and knowing your spend number. So start to create that strategy in your 60s. In 70s, simplify your finances. Don't go into retirement and into your 70s having accounts everywhere. Make it easier for yourself, make it easier for your family, and start to simplify bill paying. Make things happen naturally and easily so that you don't have to constantly be on top of everything or have to chase things down. And then finally, questions. So feel free to put questions you have in the chat box. I will answer them for you. We have another minute or so that will stay on here. I do want to share too, one common theme. People ask, like, what's the common theme that people have when they're approaching retirement? I would say people that have just saved consistently throughout their career, not crazy amounts each year. They're not sometimes even maximized, although I see those that get to max retirement contributions are really in good shape when they get towards their 60s. Just making small contributions each year and just doing something that's saving, take it out of your paycheck before you can spend it. I find that those people are really in good shape. And people that keep their debt in check, don't overspend, don't live above your means, do not rack up that credit card debt because it causes you more stress than it brings you joy. I would say the biggest challenge, someone had asked too, the biggest challenge that people have in retirement, approaching retirement, it's really, again, I think I'd shared this earlier, it's about understanding how to stop accumulating and saving and start to spend. A lot of people have that fear of spending when they get to retirement, but they need to remember that's what you did this for. You saved this whole time to do just that so that you could stop working, stop relying on that monthly paycheck, and now start to pay yourself from these savings. So that shift in mindset is really, really difficult for people. And we've done some great retirement workshops on that. So if you know someone, or if someone's on this webinar that has that challenge about thinking about that retirement flip and switch, we have a great webinar that Barbara Mayetta from our firm did in March of this year that you can find on our YouTube channel. It talks about having a purpose in retirement and how you can prepare for that. Any other questions out there? Don't see any here. So I will let you get back to the rest of your lunch hour. Thank you for joining us today. Again, please take a look at our website if you want to participate in any future webinars. And if you missed something, they are all recorded. You are welcome to review those at any of your leisure times. Thank you again. Enjoy the rest of your day. Bye-bye.